Buying that dream car is one of the major goals in our lives. Latest model, better mileage, flexible payment options, and the list of our preferences goes on. Well, apart from these, our major concern still is to get a good car loan with attractive interest rates. Whenever we apply for a loan, we hear terms like floating rates, fixed interest rates, and knowing the difference between the two is very crucial as it has a significant impact on the overall interest you would pay on your loan. So in this video, we will talk about the factors that you need to consider to make a choice between the two. But before we move forward, make sure you subscribe to the Moneycontrol channel. Let's start with the difference between the fixed interest car loans and the floating interest ones. So in the case of fixed interest car loan, the rate of interest remains the same throughout your loan repayment tenure. The interest rate does not change even if there is any change in the repo rates by the Reserve Bank of India. And as the rate of interest doesn't change, the equated monthly installments and the tenure of the loan will also remain the same. And on the other hand, when you take a floating interest rate loan, the interest rate varies from the market scenario. The interest rate here is based on the present repo rate announced by the RBI. So when the RBI increases the repo rate, the rate of interest on your loan may also increase. And when there is a decrease in the repo rate, the rate of interest on your loan will also decrease. But what should you choose? Well, a fixed interest rate car loan would be beneficial if you are someone who prefers to repay a loan at fixed amounts. You can also prefer them for stability and predictability and ease of planning for payments. Talking about the interest rates, in case of fixed interest rate car loans, the interest is usually a bit more as compared to the floating ones. But you must also remember that there may be charges or conditions attached to prepaying or foreclosing of a fixed interest rate loan before a certain minimum period. Lastly, it is recommended that if you opt for a shorter tenure car loan for up to 3 to 10 years, a fixed rate loan can be a good choice. Now on the other hand, if you choose a floating interest rate, you get to ride the interest rate fluctuations. In simple words, your car loan EMIs will vary throughout the loan tenure depending on the repo rate. Here, the interest rates are usually 1 to 2% lower than the fixed rate car loans. Moreover, you won't have to pay any prepayment charges if you opt for a floating interest car loan. Also, you can opt for a floating interest loan if you are someone who is considering it for a longer tenure for around 20 to 30 years. Well, these were the key factors that you should consider before deciding one. Apart from them, you should also make a note that the rate that a bank finally offers depends on various factors like a person's credit score, the loan tenure, type of vehicle that is electric or non-electric, and in some cases whether the applicant is bank's existing home loan customer. Also, the fixed and the floating interest rate car loans have their own advantages and disadvantages. So while finalizing for a car loan, you have to consider your own requirements and eligibility to find out what type of interest rate fits in your budget. I hope you found the video informative. Do like, share and subscribe to the Moneycontrol channel.